Technically, we are on a MACD sell signal near term. Suggests that we could see some more struggle with prices in the markets over the next week or two while we work through that sell signal. We're not oversold yet. That's that bottom panel on the chart. We're about halfway through a reversal of that overbought condition. We did take out the 20-day moving average on Friday, which is going to set up the 50-day as a potential test for the market. So if we take out the 50-day, we could see a correction back to the 100-day moving average, that orange line where the markets found support back in April. One of the outlying issues remains that 200-day moving average. We're very extended above that 200-day moving average. We're eventually going to retest that at some point, but I wouldn't suspect that to occur until probably August, September, once we get closer to the election.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my electrifying friend, portfolio manager extraordinaire, Lance Roberts. Lance, how you doing?
I do have electricity this week, so this is a good thing.
That's good. A nod to your restoration of electricity there, but also you have a new piece out talking about well, the title is Electricity Demand May Cure Debt Concerns. So if we have time, we'll get into that as well. But you're also just an electrifying personality.
I don't know about that, but sure, let's go with it.
Sitting there in your electric blue shirt. All right, speaking of electricity, folks might notice a slight change in my lighting here. And I'm just mentioning that because for many, many months now, many of you have kindly been sending me emails and comments on YouTube saying, hey, Adam, you really should upgrade your green background there. And folks, that's been the plan for a good while. Getting that to the front burner has been a little hard for a whole bunch of reasons, but I actually have a new background being created. Hopefully, fingers crossed, it'll be up in action in the next 2 weeks or so. But the person who's putting it together came by yesterday, did a lot of lighting experimentation. So I just wanted y'all to know that the new backdrop is indeed in process and hopefully should be here soon. Very quickly too, just want to remind folks for all things Thoughtful Money, just go to thoughtfulmoney.com. There you can do a host of things like get our free newsletter, sign up for a free consultation with folks like Lance, but also in terms of the newsletter, premium subscribers, this week's Macro Pass is a great one. It is an update on the all-important liquidity situation from Michael Howell and the team there at Capital Wars. So if you are a premium subscriber, go look for that in your inbox. It should be there now. And if you're thinking about upgrading the Macro Pass, that's a really good reason to do it. All right, Lance, as usual, lots and lots of stuff to talk about. But let's start, if we can, with the market action, because the market's looking a little queasy. Yeah. So let's talk about that. Even Nvidia, which has kind of been, past trading week or so, has basically been the week of Nvidia carrying everything on its shoulders, and even that stumbled the day before we're recording here.
Yeah, and again, it shouldn't be surprising. I mean, here let's just kind of go through our normal chart
straight to the charts.
Yeah. I mean, again, it's always interesting to me is people get so worked up over a little bit of a correction, and they go, oh my gosh, it's the markets are correcting, it's whatever's going on. The markets go up, they go down. I mean, you got to use that. I mean, if you just take a look at the market, it's a big jagged line. It just doesn't go straight up every day. And we sold off in April, as we talked about, in February, March. You and I were talking about, hey, we're going to get a 5-10% correction, probably pretty soon. Markets were very overbought, very extended, and we had that. And then in April, early May, we got very oversold and said, hey, and we started buying, adding positions to our portfolio, triggered a buy signal. And we had a very nice rally, through May. But again, two things important to remember is also we're in the last 2 days of the month, last 3 days of the month. So you're getting a little bit of positioning for end of the month. But again, a bit of a correction here after this big run that we had from the April low shouldn't be surprising at all. Markets got overbought, having a bit of a correction here. Again, nothing extraordinary. We're seeing some healthy rotations in the markets. As an example, yesterday, software stocks were down, like Microsoft, Nvidia, all had decent pullbacks. But a lot of other stocks in the markets did very well yesterday. So, and actually, our portfolio was up yesterday while the market was down because we had a big surge in bond prices, as well as a lot of the defensive or more economically defensive stocks that we hold in our portfolios. Those did very well yesterday. So, you had a nice counterbalance within the markets. But, look, technically, we are on a MACD sell signal near term. Suggests that we could see some more struggle with prices in the markets over the next week or two while we work through that sell signal. We're not oversold yet. That's that bottom panel on the chart. We're about halfway through a reversal of that overbought condition. We did take out the 20-day moving average on Friday, which is going to set up the 50-day as a potential test for the market. So if we take out the 50-day, we could see a correction back to the 100-day moving average, that orange line where the markets found support back in April. One of the outlying issues remains that 200-day moving average. We're very extended above that 200-day moving average. We're eventually going to retest that at some point, but I wouldn't suspect that to occur until probably August, September, once we get closer to the election. Right now, between today and June the 14th, buyback windows are open. We're now running at a higher pace of buybacks than we were in the first quarter. So we've got some bid underneath the market. So even though you're getting a little bit of a sell-off here, I'd expect the markets to hold between the 50 and the 100-day moving average, have another rally. Once we get into June 14th, that window will close. So we'll lose a buyer. Markets will probably stumble into earnings season and then potentially have a bigger correction pre-election as Wall Street kind of, repositions for what could potentially be a fairly contentious election period.
Okay. All right. Great summary.
Now, just real quick, having said all that goes out the window next week. I mean, so, it's just, predictions more than about a week are pretty useless. But if we hold to, kind of statistical tendencies and sell signals, that's how you can kind of see things playing out over the next couple of months.
Okay. All right. Let's deconstruct a little bit of the several things you said. First off, let's go look up to the MACD line there. So last week you had mentioned that we had yet to see a MACD sell signal, but it looked like we were going to get one. Looks like we got it.
We did. And again, so we got to be careful with those also. So I want to make sure and be very clear. Just because you have technical signals does not mean, oh my gosh, I got to go sell everything and go to cash. That's not what signals mean. What signals mean is hey, probably right now with a MACD sell signal in place, upside is contained. We probably won't get much upside. The market can still bounce in here. It can still rally. Even on a sell signal and not really go anywhere. And a good example of that is to just look back at early in April. So coming off that April low, we had a nice buy signal. We got a sell signal kind of halfway through April that the markets didn't really go anywhere for about a week or so. They just kind of, consolidated sideways. And then we triggered back into a buy and the market kept running higher. And then we just kind of ran along. We were just getting flipping signals, for a couple of weeks as this market just kind of ground its way higher. So then we got a good confirmed sell signal. And then that's where we had that correction in early April and then got back into a buy signal in early May. So, don't take these signals and make major moves based on a signal. All this suggests right now is that prices are the easiest path for prices right now is lower, mildly lower. Again, when combined with a relative strength index, it's already halfway through its normal cycle. There's not a lot of downside here. So again, just kind of keep things in perspective that all this really means is that upside is more limited at the moment.
Got it. Yep. Important qualification. And I was looking at our previous two videos before hopping on this morning with you, Lance, and 2 weeks ago you said, look, market's beginning to get really into overbought territory. We would expect it to start taking a breather. Last week you basically said, hey, market's more likely than not going to have a cooling off period ahead of it, and that for now seems to be what's playing off. This isn't a plunge. It's not a crash conditions. It's just, hey, it got overextended and it's going to need to work some of that off.
Yeah.
All right. So
let me say something else because that's you make great points. There are some things though that we are watching very closely that could suggest a bit more correction. Okay, and there's what's called a negative divergence, and that's these lines that I'm putting on the chart. Whoops, putting on the chart right now. And what you'll notice is that both in relative strength and in the MACD signal, they have lower tops, right? So we've got a declining MACD and a declining RSI that while the market was rising. So you've got the market kind of going up, trending higher, and you've got these relative strength and MACD signals that are trending lower. That does suggest that we could go through a longer period here of consolidation where the market just kind of goes up and down and doesn't do anything, and it gets really boring for about another month or so, and we're just kind of repeating ourselves every week on the show. But those negative divergences are important to watch because it does tell you that the relative strength in the overall market is weakening, and that could suggest lower prices at some point in the future.
Got it. And I think we talked a bit about this super briefly last week. We did because the McClellan interview was coming out the day after we recorded. Well, folks, it's now out, and Tom gets into the negative divergences that he would expect to see in advance of a material market sell-off. And just to underscore Lance's earlier point, while Tom is keeping his eye out for them, as of a week ago, he was not yet seeing them. And they're different indicators than the one that Lance is mentioning here. And Tom did mention that we're seeing some things like Lance suggested here, but he has a set of indicators that he looks at that he feels are like, pretty, dependable predictors of a major move in the market. And he is not seeing those yet. And if you want to learn more about that, go check out that video. All right, so let's see. So for the folks that are listening on podcast, Lance, and don't have the advantage of seeing the charts which you just took down, you don't have to bring it.
Sorry,
you don't have to bring it back up. But can you just you talked about we've now dropped below the 20-day moving average. You said 50-day is the most likely next support, and then if we break through that, obviously it's the 100-day. Can you just read out the numbers of where those are hanging out right now, just so folks know how far down we would need to come from today's 50 to 10 or wherever we are on the S&P?
Sure. So as we're talking right now, the market's trading at 52.10, and so the 20-day was at 52.51. So we've broken through that. The 50-day moving average is sitting at 51.7966. So it's about 35, 40 points lower than where we are now. And then the 100-day moving average is at 50.85. So about 150 points lower than where we are. And of course, if we get to the 200-day eventually, that's down at 47.73. And again, I don't expect that until probably August, September.
All right.
It could certainly happen sooner. I just don't really kind of see it at the moment.
Got it. And even if the market sort of trends sideways until then, right, that 200-day moving average is going to continue rising, right? Because it's catching up over time to where the markets are right now. So we would expect the 200-day moving average to be higher come August, unless there's some really big market downturn beforehand.
Correct. Yeah. And all these averages are going to, catch. And this is kind of the thing with the 20-day moving average. We had a pretty decent deviation from the 20-day moving average about 3 weeks ago. And this was something you and I talked about, is that deviations had gotten pretty extreme over these moving averages. And the market just kind of went nowhere for 2 weeks, and the 20-day moving average caught up. So again, those numbers I just gave you, those are good for today. They'll change on Monday, they'll change on Tuesday, they'll change on Wednesday, because prices of the market is higher. So every day that we go forward, that those moving averages are going to keep moving up because the previous 20, 50, 100 days were all higher from here.
Got it. All right. So a couple of things I just want to get your opinion on. So like I said, it's been a relatively ugly couple of days for the sectors that have led this market. Software, even AI. So we had a really big disappointment in Salesforce, which I think was down, like 16% or something like that after hours. Dell disappointed. Their AI server sales weren't as good as the market was hoping. And as we mentioned, even Nvidia dropped 3 or 4% yesterday, following a Bloomberg report that the U.S. is slowing the issuing of Middle East licenses for AI chip makers. So all of a sudden, there might be some geopolitical limitations placed on AI sales. Um, uh, it's interesting because, like I said, this has been the ox that's been, dependably just grinding the market higher here. Can we take anything from this more at this point than hey, it's just a stumble and no need for worry yet? Or are we beginning to see signs that, the ox is getting tired?
Well, you got to be careful with this. First of all, you got to remember that markets kind of always get ahead of themselves. I'm writing a piece for next Friday talking about the commodity cycle, the boom, and why commodities always boom and bust. It's never a steady trend in commodities. Either you're making a killing or you're losing everything. This is why commodity traders are either rich or broke over time.
Yeah.
And the reason is, and just we can use copper as a good example because it's been on a tear lately. So everybody's buying copper because AI needs copper, and and it takes a lot of copper to build EVs. And so we run up so there's more demand for copper than there is actually supply of copper initially. So the prices move up. And then Wall Street says, oh, look, the prices of commodity, the price of copper is moving up. Let's go buy futures on copper, which drives the price higher. Well, in response, copper producers say, oh, look, I can get a whole lot more per pound of copper. So people go out and they steal copper out of houses and producers produce more copper. And we keep bidding up the price of copper. So we keep finding more ways to get more copper to market. We ramp up production. We hire more people. We buy more equipment. But the reality is, is the actual demand for commodities isn't running at that rate. We've now introduced speculation, and so we have the speculation in copper prices, which brings on too much supply ahead of demand. And then once we have too much supply, and of course, as with all things, it's always about supply and demand. People say, man, I got a glut of copper now. I've got to start selling it a little bit cheaper. Prices come down. Futures, Wall Street then starts, selling their futures contracts, taking profits, and then shorting copper, which drives the price down. And so we just go through this boom bust cycle consistently. And if you actually take a look at copper over the last few days, you've already had a pretty sharp correction in copper. So that's Wall Street, right? So and that's what happens on Wall Street with everything, whether it's AI or whether it's commodity prices or whatever it is. Wall Street grabs a hold of it, and then we have this big chase that gets ahead of what's actually happening. And is the demand for copper? And I've gotten a lot of questions lately about uranium, right? Because we're gonna need nuclear power. Mm-hmm. That's great, right? I mean, and that thesis is absolutely true. And that's kind of the structure of the article I wrote today is that, the demand for the build out of our electric grid and power grid is going to require massive amounts of copper, massive amounts of uranium. The problem is it doesn't need it all today. And so it's going to, the build out of a power grid is going to take 2-3 decades. And so there will be a demand for copper over that time frame that's more than it is today, but it doesn't all need to be done today. And so Wall Street always kind of gets ahead of the actual demand. Same thing for uranium. It takes 10 years to build a nuclear power plant with, getting licensing and all permits and everything else. It takes about 10 years to build a nuclear power plant. So you don't need the uranium until the very end of the construction, right? So
that 10 years of fast track, by the way.
Yeah. And so, that's fast track. So the problem is always the case is Wall Street gets the narrative way ahead of the reality of it. And then, yes, all this AI that we're doing, it's absolutely coming. It's going to be a huge demand change within the economy. It's going to create a whole new aspect of job creation. And, Adam, you'll remember this. Back in 1999, 2000, when we were in the middle of the dot-com, boom, I remember people coming out of college that could design a website, and they had the ability to program HTML and basic website code, and they were getting job offers for $350,000, $400,000. They were getting Mercedes as a signing bonus, et cetera, because there were just not enough people to do that labor. Well, flash forward 10 years later, those jobs were running between $40,000 and $50,000 a year because we had this big flood of web programmers. Well, I just was looking yesterday. Right now, jobs in AI, if you program AI and can develop AI, those jobs are paying $350,000 a year. So everybody will go become AI programmers to get those $350,000 a year jobs. And we will get a glut of AI developers who eventually they'll pay $35,000, $40,000 a year. That's just the cycle of economics and how it plays out over time. And just like everything, we create these boom bust cycles within the overarching theme. It doesn't mean the theme is wrong. It just means we've gotten way ahead of where we should be at this stage of the cycle.
So it's interesting you say this. So I'm going to questions I had further down the list here. Here was a question I was going to work up to, but you kind of just put it on the tee here, which is AI going to need to show some bottom line impact pretty soon to support today's valuations in the market? Are we going to get like what we saw in the dot-com bubble, where people realized, wow, yeah, this thing may revolutionize the economy, but it may be years more than we've gotten so excited about in the stock prices?
I think that's particularly the case in companies like Dell, where you're selling a computer, and the same thing for SCMI, which is the small cap company that provides computers for AI, right? You're kind of on the back end of the development. So, Nvidia is on the front end, right? There's, so as you build out a data center or you build out, Elon Musk just said he's going to spend $6 billion on XAI, which is his artificial intelligence. So Nvidia is on the front end of this. So they are clearly showing revenue and profitability from the AI chase, right? You look at their sales growth over, year over year, quarter over quarter, look at earnings growth, et cetera. Clearly, they are benefiting from this build out of AI, but they're on the front end of it. On the back end, which is going to be ultimately the delivery part of AI, a lot of those companies that are on that side, particularly in the software space, like Salesforce is a good example. I think that's going to be they're going to benefit from this, definitely, but I think it's further down the line that they see that revenue growth. And again, a lot of these companies have just gotten so far ahead of themselves, looking at what they can actually generate in revenue versus what their valuations are at. I think that's going to be hard to maintain. I think the market's kind of coming to that realization. So yeah, I think you're going to, as with all things, we're going to have a big case of winners and losers within the market near term. And we're going to see some pretty big corrections potentially in stocks that have really gotten too far ahead of the reality of what they can actually generate in terms of earnings and revenue.
Okay. And some of the Magnificent Seven are in that, right? I mean, where you've had Microsoft and Google and a lot of these AI, software creators, they've got these large language models that they've been building, but the actual bottom line impact of that is something that's still in the future. So right. You're nodding as I'm saying this, but if those cool off, that really can weigh on markets because the Magnificent Seven is such an over-owned cohort of stocks, right?
Yeah, I mean, like one of the stocks that we own in our portfolio is Amazon, right? Because in the discretionary space, it's pretty much king. But we don't really look at Amazon in terms of, and I'm talking about not we as me, but we as the marketplace. We don't really look at Amazon's earnings and go, well, how did the retail side of their business go? We don't even care about that. It's like, okay, yeah, that's fine. What did AWS do, right? Which is their web services. And that's their data centers and all that. And that's really what's been the focus of Wall Street when it comes to Amazon, is what's happening on that web services side, and that's their AI side, et cetera. The retail the retail consumer side is kind of a secondary thought, right? So, I think there's some companies in here. Microsoft certainly got a bit of risk here as well. They have a lot of discretionary side of their businesses, whether it's video games or whether it's Xbox sales or whether it's software sales, that really don't have that much to do with AI. We look at Microsoft at the moment and going, okay, they're going to, they're building the data centers. They're going to be kind of the support side really of AI, but they have a lot of other businesses that are very economically sensitive that we just don't pay attention to now on the AI chase. But I think it's going to become inherently more important over the next 6 months to a year.
Okay. All right. But then to transition into the piece that you just released about electricity demand may cure debt concerns. I believe that the general thesis of that piece is, hey, look, we're making a long-term infrastructure investment here that should boost productivity, economic productivity. And so, in a couple of years' time, we may really start beginning to reap the bounty of that investment, and don't undersell that. And for sure, and I'm going to put some words in your mouth, but I think I can do a pretty good job of channeling Lance Roberts, which is, hey, for those of you that understandably are very nervous about the $1 trillion of new debt that we add every 100 days, and a lot of the profligacy that we're seeing right now in spending by the U.S. It may not be as big of a concern as you may be imagining right now, because we may get this boost to productivity and growth in a couple of years that may help us start to grow out of that debt burden at least a bit. And this is the Lance Roberts that says, don't take a headline and push all your chips on it and build your bunker because the dollar is going to die tomorrow because the U.S. is drowning in debt. This may actually be a factor on maybe a net basis that actually is net positive in the long run. Did I channel you well?
Sort of, yeah. There's a big component to that, which is that what happens. So back in back during the Depression in the United States, we built the Hoover Dam, and that was a government expenditure of debt. And so we took government debt and we built the Hoover Dam. That's a productive investment. So we used debt to build something that produced electricity, which consumers to this day still pay for. So that use of debt is what we call productive use of debt.
Right. And you mean still benefit from, like we're getting a net positive return.
Yeah. It's the Hoover Dam has paid for itself multiple times over. Same thing with the Tennessee River Valley Authority. So, what's going to happen in the future is that our electric power grid has not been updated in about 30 years. We kind of build onto it, but we've never had to re-innovate it to a degree. And the amount of demand of power, and it's not just AI, right? So it's electric cars, computers, phones, and as we grow our population, everybody has one phone, if not two. For my wife has two phones, one for her, one for work. Multiple computers, televisions, all these things. So all that power demand is increasingly becoming more onerous on the current electric grid. And solar and wind, they'll always be a small fraction of the power generation. They're just not efficient in terms of creating power for what you have to put into them. So natural gas, nuclear power, the market will be forced eventually to move in that direction. Geothermal, tidal, those types of energy generation that will be forced by the market to move in that direction, simply to get more electricity out of the generational process. And in order to move that electricity, it's great that we can produce it. We then have to move it across power grids. So now you're talking about thousands upon thousands of jobs being created to build out the power grid. And as we talked about earlier with copper, huge demand for commodities to build out, whether it's concrete or copper, rubber, plastic, all the other stuff that's required, oil, to build out this infrastructure grid is going to create tons of jobs. Those jobs then create, again, I'm producing something, so that creates income, which gives the consumer something to spend, which then creates more demand in the economy. And you start creating this productive investment cycle that increases economic growth. Very much like we saw in the 50s, 60s, and 70s, where we were running rates of economic growth at 6, 7, 8%. Because we were manufacturing, not doing services. And so this whole potential for the build out of this power grid converts us, and I quote Woody Brock, who is a very brilliant economist in the article, and he talks about you have country A, country B. Country A issues $1 trillion in debt, uses it for social welfare. They still have $1 trillion in debt, but no income to pay for it. So that's not a good way to go. Country B issues the same $1 trillion in debt, but does it productively, creates income that repays that investment over time, and then creates a profit of a revenue stream for the government on top of it. That's a productive use of capital. And so what this potentially sets us up is to go from country A, which is where we are now. And yes, if we remain country A, the debt that we're spending, the debt to GDP ratios at 120% are problematic long term because it will continue to erode economic prosperity. But if we can convert in the future, now we're talking, decades, but in the future, if we convert to a more productive investment cycle of building out the power grid, creating this infrastructure to deliver the electricity needed to generate AI, which is going to change the way we do everything. You won't be doing this anymore. It'll be your AI counterpart doing your videos, but that's going to convert the U.S. from being country A to country B, which has an entirely different dynamic when it comes to issuing debt.
Okay. So, I think it's important to make sure that we, keep this perspective because, look, I'll be right there at the front of the line saying that much of what the government does, it does ineffectively.
Absolutely.
But we can't discount the fact that if we are making, amidst the ineffectiveness, that we are making actually long-term beneficial infrastructure investments, that those do have the potential to create long-term constructive additive effects to the economy. And so again, I'm really trying to channel you more than anybody else, Lance, which is like, if you've got your long-term bear hat on that just says everything's going to hell in a handbasket, it is more nuanced than that, and we are likely to see some real long-term good come out of this spending. There'll probably be a lot of long-term, bad investments that are made along the way, but it is not it's not an all or nothing type thing. And related to that, I just want to pull this thing up because we touched upon it briefly. I've had a couple of interviews over the past years about nuclear energy, and I think I've been pretty pretty clear, at least on my own Twitter feed, that I just don't see how the world doesn't return to embracing nuclear as, really the highest density, cheapest form of dependable energy going forward. And a number of folks that I've interviewed had sort of made the prediction that, nuclear energy will eventually become classified as a green energy, where it's been largely demonized by the green cohort for decades. And I just want to share this notice that just came out from the White House the other day, talking about how the current administration is bolstering domestic nuclear industry to advance America's clean energy future. So I think the rebranding of nuclear as a green source may already have happened. It may have actually just crossed that line. And in this future of heightened energy demand and a more electrified power grid, I just don't see how you can really do that sustainably without nuclear, short of some brand new energy technology breakthrough from here.
Well, no, and look, it's like, batteries now, they're like electric vehicles with their batteries, they have got limited range because of the efficiency of the battery. That's going to improve, right? We'll build solid state batteries, and some whiz kid from, some school will come out and create some whole new battery structure that allows the battery to take a car, 1,000 miles versus 250, 300, whatever it is. So we're going to make innovations in the future that are all going to improve, what we're trying to achieve of getting a cleaner overall environment. But part of this is also going to have to come to the realization that there's certain, and again, you got to remember, a lot of policies are passed by industries that want to benefit from the policy. So solar, wind, those type of things, those were heavily promoted by those industries, and they've gotten a lot of subsidies, et cetera, to build solar and wind, but they're just not as efficient. Natural gas, nuclear, nobody wants to invest in that because, we've got, 3 Mile Island and Chernobyl fears, which are very rare occurrences. I mean, we've been running nuclear subs for decades, right? And things don't happen all the time. They're rare events, and they're terrible events when they certainly occur. But things have progress, technology, everything's gotten better over the previous decades. So the events of those catastrophic outcomes are becoming fewer and fewer. Natural gas is an extremely abundant source of cheap energy that can power cars and all kinds of other stuff. So, we're going to have to make this shift mentally to, rather than just trying to focus on one industry. I'm not saying getting rid of solar and wind. I'm not saying that at all. Just looking at them as a global basket of ways to produce cleaner energy and more environmentally friendly energy, and say, okay, where do we need to put in the most money? Where do we need to focus our efforts? And that would clearly be natural gas and nuclear. Still have and solar and wind power being those, but again, tidal energy, geothermal. There's so many other types of energy production that are much more efficient. That would be where we'd be better off, especially if we use government debt to do this, which we will. We'll pass infrastructure spending bills to join into this build out. Yes, utility companies are going to be spending a lot of money, but they're going to lobby the government for money because this is a national security issue. As we talked about before, the government has two jobs, and only two jobs. The education, Department of Energy, all that needs to go back to the states. The only two jobs of government are infrastructure and national defense.
And keep us safe, yeah.
Yeah, and when it comes to the power grid, that is infrastructure and national defense. So the government is going to be involved in the build out of this because it is its sole responsibility. Really, when you look at the factor of what the responsibilities are, that is their responsibility to build out the power grid. So the government is going to get involved in issuing infrastructure and debt to do that, but it is going to be a private-public partnership, ultimately, with utility companies also spending money to do the build-outs as well.
Okay, so then here's where I've been getting to.
I should also say Wall Street will be heavily involved in this. BlackRock has already been to Texas multiple times, lobbying the state of Texas for infrastructure.
Okay, so where I'm going with all this is, as a capital manager, how does this outlook, which certainly seems that you have around this, how does it play in your investment strategy development? Because obviously this is something that's going to happen over time. It's not going to happen tomorrow, but I would presume from what you just said that you would be looking at energy as probably an increasingly strategic part of a portfolio going forward.
Yeah, but we got to remember, this is decades.
I just said it's not going to happen overnight. Yeah, no, I get it. Yeah.
But no, in our portfolio, for instance, we own ONEOK, which is a natural gas pipeline. We own ExxonMobil. We own Diamondback Drilling. This is a very small percentage of the portfolio, but we have exposure to those areas. We also own American Electric Power, Duke Energy, because those are going to be two of the primary energy utility providers because of where they're located country-wise. That they're going to be two of the primary grid providers for where the data centers are actually located. So yeah, we've already got small investments in these areas, and as they come to fruition, we'll continue to build out on those as this thesis comes together long term.
All right.
And one of the portfolios right now that we're building two portfolios right now. To launch on SimpleVisor, which is an AI portfolio and an infrastructure portfolio. So we're also building some thematic portfolios that if you just want to have a chunk of your money invested in a theme that you're going to just hold for the next 10 to 20 years, we'll have a portfolio for that.
All right, and now I feel bad because I didn't remind folks at the beginning of this video that this is not going to be the SimpleVisor. I mean, they've already figured it out by this stage, but this is not the SimpleVisor walkthrough week. But that's coming up.
I got a ton of emails this week, but this weekend I'm actually building all the models to put on the website. So hopefully, then I've just got to turn it over to our programmers, have the programmers put all the models on the website, and we should be good to go.
Okay, which means we're still a couple of weeks away.
A week or two, yeah.
Week or two. Okay.
My goal is to get it done before I leave for Greece. So that's the goal.
Oh, good. When are you leaving for Greece?
July the 7th.
Nice. Okay. I'm making a note here because I got to talk to your colleague to see if he can sit in for you while you're gone.
Yeah, no worries.
Okay, but so really great to hear that you're having those thematic portfolios. But I'm curious in terms of, the RIA general portfolio. Um, I mean, I'm presuming, maybe it's the wrong thing to take away, is that you may increase the general percentage of the portfolio that goes to energy as we move into this future, right? So something over years. But let's say something like nuclear, right? That's going to take a while to really play out, right? But you may have high conviction that it is going to be a factor in 5 years, 10 years, whatever. Um, is that something that you'll take a small position in at some point and then grow it as fruition happens? Or is it something that you'll be more like a momentum player, like, okay, when the market does wake up to it, that's when we'll get into it?
A little of both, honestly, because remember the issue that I have, which you don't have, right? I can lay out this theme for you, and if you're willing in your own portfolio to sit there and go, I'm going to buy these stocks, I'm just going to hold them for 10 years and never look at them. You're going to make money. You'll do fine. The problem is I don't have that luxury because everybody that signs up for SimpleVisor, they look at what the portfolio did today versus the market tomorrow. And if it doesn't perform today with the market, then they're trying to move their money somewhere else.
Yeah.
So as you know, this is the problem that I wrote about in regards to benchmarking, is that the media's got us so involved in just looking at performance versus the market that I don't have that luxury to make big bets in a portfolio that may not, they'll eventually kill it, right? But by the time they would work, in theory, I won't have any clients left because I've got this massive chunk of money invested in something that will eventually pay off huge dividends. But if my performance drags for years, they'll be like, oh, he's a terrible money manager. His performance sucked over the last year. So I'm moving my money somewhere else. But then eventually these themes will pay off and, we'll make huge money. So, you've got to really, like I said, for me, I just don't have the luxury. I have to generate performance from month to month, year to year, because that's what people want, right? That's how they focus on everything. Market's up, am I making money? And that's not investing, right? That's just speculating. But as a portfolio manager, I'm forced in a manner. I can allocate portions of the portfolio to themes that we think will pay out over time, but they can't be so large in the portfolio that they destroy performance if they're not working.
Okay. So let's say one of your clients calls you up and says, hey, Lance, love you guys, love what you do, but I'm really excited about nuclear. How do you work with somebody like that? My presumption is that you say, hey, great, let's talk and let's try to determine what percent of your portfolio we might carve out for that play. But note that that's something that might be a sleeper investment that might not, pay off for years. I'm going to keep doing what I'm doing with the remaining 96% of your portfolio. But sure, if you want to carve that out, we'll work with you to create it, right?
Yeah.
You're not saying, yeah.
And we do that all the time, right? We open up a separate account and it says, okay, so you want to put $100,000 in nuclear. Great. We'll open up a separate account, put $100,000 into it, buy the positions, and then we'll help you watch them. And then if something falls out of bed, we'll say, hey, probably should sell that one and maybe swap it for this one over there because, something happened, regulatory change, whatever happened, and that's changed the theme. But yeah, we separate that out so that it doesn't, because again, at the end of the year, the client goes, okay, well, how'd my portfolio do? It's like, okay, well, if we had that pool of investments mixed in with ours, it lowers the overall performance of our portfolio versus the market. So in order to make clean comparisons, we separate those things out.
Okay, good. Yeah, I just didn't want anyone to take the mistaken impression that and I really appreciate you sharing the constraints that you have as a capital manager, that they were like, oh, well, then I can't, work with these guys if I have strong convictions and some of these long-term plays. Not at all. Yeah.
Yeah, not at all. But look, my job is to make clients happy, right? So, if you want to buy whatever you want to buy, I can certainly, build a portfolio that surrounds that, whether it's Bitcoin or whatever else. I mean, we've got lots of options now with ETFs and everything else to participate in all these different markets. And, we have, sorry, I hit my computer. For instance, we've talked about gold and stuff here before. We have a portfolio that has gold in it. It's not the portfolio that I talk about with you about, because that's our 60-40 benchmark portfolio. So that's the one that, we kind of focus on just because it's kind of a general in the middle of the road portfolio. We have portfolios that are 100% equity. We've got portfolios we have a bunker mentality portfolio. So, we've got a portfolio probably for just about every, class that somebody would be interested in that would fit their profile.
Great. Let me ask you this, and you're just thinking of this aloud as you mention it, but you have a fiduciary responsibility. So if somebody says, "Look, I've got a strong conviction about gold or nuclear," I totally see how you can say, "Great, well, we can help you with that, and we'll set up a separate account, we'll track it, we'll help you with it, whatever." Where do you draw your line where somebody says, "I want to put a huge chunk of my wealth in, crazy coin or meme stock X or whatever"? Like, what are your criteria for saying, "Hey, you know what? We can't help you with that just because we think it is so against your interests, we would be breaking our fiduciary responsibility"?
So two things around it. I just actually had this case just not too long ago. We had a client, kind of approach us and said, "Look, I want to put half my portfolio in a particular stock." And we were like, "Okay, we don't think that's a really great idea, but you need to sign this document that releases us from our fiduciary responsibility. We'll manage the other money. You're going to be responsible for that. But we did not make this recommendation." And so you sign a document that basically, segregates that whole transaction from everything else we're doing. So again, we take our fiduciary, and then we've had other people that email or whatever, they show up and they go, "I'm super aggressive. I want to make 15% a year is my goal." And we go, "We're not your guys." Right? We're not going to be able to do that. We don't think you'll be able to achieve that year after year. You're going to wind up probably hurting yourself. And so I would recommend you go, somewhere else or find somebody willing to do that for you. And, I think that's, if anybody, I think that's one of your kind of key tells is that if you go to an advisor and say, "Oh yeah, I can generate 12, 15% a year," I'd be really cautious of that because markets don't do that. You can do that from 1 year, maybe 2 years in a row if you have to get into a really hot market. But, the downturns tend to be much more devastating taking on that much risk. So you always have to align the risk that you're willing to take. And people really misunderstand this word risk. They go, "Oh, I'm very aggressive. I'm willing to take a whole lot of risk to make a bunch of money in the market." That's fine as long as markets are going up, but that's not what the word risk means. Risk means how much money you lose when you're wrong. And, I can't tell you how many times I've seen people that are, "Oh, I'm super aggressive." And as soon as the market dips, 3, 4, 5%, they're like, "Get me out."
They turn on a dime. Yeah, exactly.
Yeah. And so, understanding, risk and reward is extremely important because if you can't adhere to your investment, look, there's a true statement about time in the market. We're not market timers. We do look at technicals. We increase risk. We reduce risk relative to markets being overbought and oversold. That's not market timing. We're looking at risk in the markets and making adjustments to portfolios. We're speeding up the car, slowing, tapping on the brakes to go around a corner. That's just managing risk. Timing the market is where you're all in or all out. And that's very difficult to do. It's impossible to do consistently. You're going to miss the tops. You're going to miss the bottoms. And so there's this big confusion in the markets because what a lot of advisors will tell you is that you can't manage money. They'll say, "Oh, you can't time the market. Just buy an index and hold it and you'll be fine." And the reasoning they use is well, it's time in the market that matters. And yes, over the long term, time does benefit you. And if you just want to buy something and hold it for a very long period of time, you'll make money. But managing risk will give you better returns over time just because you're limiting the downside draw. Getting back to even is not the same thing as making money.
Right. We've talked about that, and you've shown the charts of, if you're able to miss the 10 worst days in the market over a multi-decade period, your return skyrockets, right? So it's totally agree. And by the way, folks, I've got a big Nvidia question for Lance in just a second, but I want to make one more point on this theme, which is, as we've talked about many times, humans are pretty bad at estimating risk for a whole bunch of reasons, but the type of risks that we deal with in the markets are not the type of risks that our brains evolved to assess well. And one of the things that people do is they chase performance, right? So they see a fund or they see a fund manager or an advisor who had a blowout year last year, and they say, "Oh, that guy knows how to beat the market," right? And what they tend to do is they tend to put themselves at the risk of mean reversion, right?
Yeah.
Which is you're seeing the guy who actually had the outperformance year. He had essentially the lucky year, right? And so you chase him, or you chase the fund that outperformed, and then reversion to the mean kicks in, and usually the next year is an underperforming year, right? So if you're chasing performance, you tend to have a higher probability of underperformance because of that reversion to the mean effect. The other thing too that I'm seeing a lot of right now, which worries me, is I did a poll on my Twitter account asking people, hey, are you more of a DIY, or are you more, really wanting to have somebody manage your portfolio for you? And the vast majority of people were DIY and pretty happy about it.
Mhm.
And a lot of them have said, like, well, I've just been killing it, the past year. So why would I change, right? And that's great. I mean, look, happy you're doing well. And if you've got a long track record of performing well, great. You should be managing your money. But rising tide markets like we've had for the past year and a half of liquidity, you go back to that old John Hussman quote, which is, he says it around bubble markets, but he says they force you to make a choice: look like an idiot now or look like an idiot later. And you can kind of flip it and look like a genius now or look like a genius later, right? Where everybody feels like they're a genius when the rising tide is rising all boats. And I did the interview a few weeks ago with Nicholas Eberstadt about people dropping out of the workforce, and more folks than I'd imagined said, "Yeah, I know, I'm one of those guys. Screw working for somebody else. Corporate America sucks, but I can trade stocks, and I'm making money every month." And I'm just thinking, oh gosh, I'm glad you're making money right now, but I think you're developing a false confidence in your trading ability. You're mistaking correlation for causation here. And when the market does have, as it inevitably will at some point, a reversal, these people who are so confident in this easy way to make money in the markets will suddenly be sitting on losses that could take them longer than they can afford, as you said, Lance, just to get back to even.
Well, and but none of this should be a surprise, right? I mean,
None of
most
it
of the,
should be,
right,
but
right, yeah. But think about it, right? So most of the people you're talking to have never seen a real bear market. They started investing in 2010, 2011, 2012, where we've had literally $47 trillion worth of liquidity dumped into the financial markets. And we've talked about this before, is that from 1900 to 2008, the average rate of return for stocks was about 8%. So that's 6% appreciation plus 2%
plus
in
dividends. Yeah.
right? And 6% appreciation is equivalent to the growth rate of the economy over that period. From 2009 to present, we've been growing at 12% a year. So we've added we increased the rate of return by 100%, 50% by going from 8 to 12% over the last decade. So most people have never been through a bear market, and most people have never seen what a real bear market does. They've also not seen a market that's not been supported by zero interest rates, massive Fed interventions, et cetera. So we've created these very outsized returns where, man, if you just threw money in some of the most speculative stocks, you've done very well. But if that's the case, and this is the always the interesting thing about DIYers, the DIYers were doing great in 2019 and 2020 they did 2019, 2018 they're doing great. 2020 comes along and all those stocks that they were piling into and chasing, the GameStops, the AMCs, the Rokus, they crashed by 90% in 2022. So all that money they made went out the window, and we read all these articles. You and I had discussed them, and I wrote articles about this. Is that all this youth that was chasing stocks and trading markets with Robinhood apps and everything else, they were just buying the most risk they could, and it was easy. They were just printing money hand over fist. By the end of 2022, a lot of those guys were gone. Stories in the Wall Street Journal about how a guy with $3 million in profits is now back to waiting tables in Vegas because he lost all of his money. And all you have to do is understand is that DIY, do-it-yourself investing is fine if you're very consistent and you're very conscious about the risk that you're taking. But if investing worked the way that the media makes it sound like it works, then why is it that 80% of people don't have any money to invest, right? They've got $500 in the bank. And it's because these serial booms and busts that happen in markets over time keeps wiping out all that money. And then they can't get back into the markets, or they don't get back in the market. Risk taking is great. Bull markets make you think you're a genius. But when that eventual bear market correction comes, and it will, and again, we saw this in 2022, the market was only down 20%, yes. But if you look below the surface of the magnificent 10 at that point, those top 10 stocks like Apple, Microsoft, and Google, a vast majority of the market was down 50, 60, 70% during 2022. We just saw, take a look at ARK funds, the
Right.
Cathie Woods Innovator Fund. That thing got absolutely decimated during 2022. And a lot of people had all their money in that, right? Bitcoin got crushed. People lost tons of money in that. But that's what happens. And this is why it's very important. Look, being a do-it-yourself investor is fine. And that's why we built Simplivisors, to help you do that better. But again, it comes down to fundamentals. It comes down to risk management. And it doesn't come down to beating the market every single year. That's not your goal. And I did this article on the website called Benchmarking. And, every year we get this, always see a bunch of advisors writing this article like, oh, the SPIVA report, which is this report by S&P that says, it basically measures all the mutual fund managers and says, okay, how many mutual fund managers beat the index this year? And every year, these advisors come out and say, see, this is why you should just buy an S&P index and hold it, because 80% of fund managers failed to beat their index last year. That's a true statement, right? That's a true statement. Nothing wrong with that, except it's way out of context. Because just because a manager didn't beat his index last year didn't mean he didn't beat it the year before. Didn't mean he didn't beat it this year coming up. And so when you start looking at long-term portfolio managers, have long-term track records. And I just grabbed 5. I didn't even really search very hard. I just grabbed 5 funds, just kind of off the top of my head: Sequoia, American Growth Fund, Dodge and Cox, Fidelity Contra Fund. The bottom line, the lowest line, that's the S&P 500. All these mutual fund managers creamed the S&P over 30 years. They made you, Berkshire Hathaway has made you a ton of money over 30-year period of holding it. Did they beat the market every year? Absolutely not. The odds of beating the market every single year is 1 in 2.6 million. And Bill Miller did it for 15 years. Peter Lynch did it for like a decade, and they both failed miserably after that. So again, it's about risk management. And again, it's not about what the S&P does. The S&P has nothing to do with you, your portfolio, your life, your time horizons. It's a random index. But what matters is how much risk you take in your portfolio. And if you wind up destroying a big chunk of it, you're never going to reach your goal, because you're having to get back to even. And every year that you're just getting back to even is a year of that 6% that you needed to get to reach your goal has now gone.
Yeah. And it tends to injure those who can afford to lose the most. Least. Right. Yeah, exactly.
And the ones with the least amount of money, look, I've never met a really wealthy guy that goes, oh yeah, I just want all the risk I can take. I can tell you for a fact, guys that have made a lot of money in their life, they're like, Lance, just make me some money, just don't lose it, right? Because I can't make it back.
Yeah,
right?
And I think that's a great point, which you know better than I, which is when people have a liquidity event or they've made a lot of money, right? They generally turn to a high net worth advisor and say, please, just manage this in a way where you don't lose it, and then hopefully I get a nice income stream off of it that I can, right? What they don't do is say, oh, look at all this money I have. I'm going to day trade and make that pile even bigger.
Yeah, the only people that do that are people that have no money to start with. They're just hoping to invest to get rich. And look, the markets are not designed to make you rich. The markets, if you treat the market like a casino, the market will treat you like a casino, and they'll take all your money.
And they'll take all your money. Yeah.
If you invest smartly and treat the market for what it is, which is to grow your savings at the rate of inflation, long-term inflation, not near-term inflation, but just grow your money at 3 or 4% a year. If you do that, you're going to do great.
Yeah. Well, and as you say often too, it's really put the market aside and ask, what are my goals? What do I need to hit? How much do I need to have by when to hit my goals, and make that plan what you're investing for, because you may be able to take a lot less risk than being just in the general market and still be able to hit your goals, right? And that's the smart way to go.
Right.
Let me just make one last point on this too, where you talked about we should have had this step function in the return of the market post 2000-ish or so, right? From 6% to 12%. And that's coincided with the 45 trillion or whatever number you said, which really is just intervention, right? It wasn't a step function in economic productivity or economic growth. And so because there isn't a step function in actual value creation, what that step function does is it pulls tomorrow's prosperity into today. And as you say very often, Lance, there's no free lunch on Wall Street, which is at some point in time, the piper is going to need to be paid, likely with lower than average market performance at some point, because we pulled so much of it into the past couple of decades.
Yeah, this is the arithmetic average annual. This is the average real return of the S&P over different time frames. But you can just see that post 2009, 10, 11, when we kind of went crazy. I mean, we just had a massive lift in rates of return over long-term history. And again, that's just directly a function of how much money we just threw into the markets during that time frame.
Got it. And all I'm just saying is don't assume that higher level of market return is going to continue in the perpetuity of your investing career, because at some point we will highly likely have to have a hangover from the party that we've been having.
Yeah, absolutely.
All right. So let me get to my question for you about Nvidia. We kind of took this detour here, but a valuable one. So you probably remember, Lance, back in the dot-com era, there were a lot of companies that got caught what was called round tripping, where this was back. These were companies that were supported by advertising, and they would basically it was almost kind of like a shell game, right? I'll advertise on you, you advertise on me, and it'll look like we're kind of growing the pie, right?
Right.
So here is a question that was sort of raised on X Twitter, saying, hey, is Nvidia doing something similar? Here's the pattern that they're seeing. Company A buys GPUs from Nvidia. Nvidia in turn buys cloud computing credits for future cloud computing services from this company, and then both companies report these transactions as revenue. So I have heard some people raising the question is hey, how much of Nvidia's blowout sales are actual real sales, and how much of it is funny money and kind of vendor financing and that type of stuff? Do you have any strong opinion on this?
No, look, I mean, there's certainly some questions that I have, which is basically Nvidia is going to run into the law of large numbers at some point, right?
Right, and that's if it does everything above board. It's
correct, right? So I mean, you just get to 1 billion to 2 billion, right? That's one thing. 2 billion to 4 billion is one thing, but to try to grow at 200% or 400% a year is going to be extraordinarily hard going forward. So one of the things that's going to have to occur is that Nvidia is going to get into a period where its growth rates are going to slow. Now, Wall Street will start to anticipate this. We saw this with Apple. Apple sales and revenues have been slowing for a very long time, but the expectation was factored into their earnings. And of course, Apple's bought back almost $750 billion worth of stock to help boost earnings. So there's a lot of funny money stuff that goes on with companies, period. The question is whether or not that Nvidia can continue to generate the rate of growth that it's currently got. Here's the thing to be careful of, is we can come up with lots of correlations back to 1999, 1998, 1997. I lived through that. You lived through that. You know all the stuff that was going on. The ramp up that is expected in AI is virtually parabolic. I mean, it's just, AI is just going to do this over the next, 15 years. That's probably not going to happen. Things are going to occur. Supply demand imbalances are going to happen. And, we're going to tailor off probably that growth rate at some point in 3 or 4 or 5 years. The risk right now of trying to apply narratives like what you've got to Nvidia is we're very early in that cycle. And so the thing you got to be careful of is being trying, saying, okay, this is going to crash just like, Cisco did back in 2000. That may be the case, but we're very early in this AI cycle, right? I mean, we're right at the forefront of building out all these data centers, et cetera. So there's a lot of demand for these GPUs from Nvidia right now, and there's not a lot of competitors. So the thing to watch for is if we start getting more competitors into the markets, we get other manufacturers that start coming up online to generate, to sell GPUs or develop a better GPU, et cetera. That's going to start eating their market share. And so you want to watch is the pricing that Nvidia is charging for their GPUs. Right now, they can maintain a fairly high price for their GPUs, but we just saw recently that Nvidia is starting to have to maybe cut prices to sell some of their GPUs overseas. So that's going to eat into profits. But so, this will all show up in revenue and earnings. This is why we pay attention to revenue and earnings, X buybacks, is because that tells you about the growth rate of the company. Right now, they're doing great. They're, the stock is ahead of itself. It's going to go through a correctional kind of consolidation phase like it did just last year. It'll probably spend 4, 5, 6 months not going anywhere, maybe even decline here a bit, just as we kind of work in some of this, kind of work through some of this very overbought condition in Nvidia. But I think it's really way too early. If you're long Nvidia right now, we're long Nvidia at the moment. We increase and reduce exposure to Nvidia all the time. We sold some earlier this year, bought it back in April, trimmed it before earnings. So we manage our risk in that position for quite some time. But I think it's too early to start applying a narrative that says, oh, Nvidia's going to crash, I'm going to short the stock. I think that would be a terrible mistake at this point because you're way early in that cycle.
Okay. And just again, sort of the spirit of the question, I know you don't know necessarily, but how much of a concern do you have that part of their success is sort of shenanigans versus that may come out the way that the round tripping did versus real true organic demand?
Yeah, but remember the round tripping didn't come out till after everything crashed. So, it didn't come out ahead of time. No, look, I mean, that's going to, again, it's going to show up in earnings at the end of the day. It'll show up in revenue growth. It'll show up in earnings. Pay attention to the fundamentals. Forget the headlines. If you want to be a better trader, pay attention to the fundamentals and the technicals. Forget the headline stuff. Everybody's got a narrative for why this is going to crash or that's going to crash or this is going to go to the moon or that's going to go to the moon. Those are fine, right? But that's just an opinion. The facts will tell you. That's why, again, at the end of the day, I don't watch television. I don't read headline stories. I don't watch other people's videos. I download raw data, and that's what Mike and I look at.
All right. Okay, speaking of raw data, the day you and I are recording here, the new PCE numbers just came out. So let me just pull them up here on the screen. So the market, I think, sort of interpreted this as positive development where PCE is I think it's remained flat year over year. It came down month over month, 0.2% in April compared to 0.3% in March. So it's a slight cooling. We're seeing some of the annualized data begin to turn down a little bit. I guess the 3-month is down, although the 6-month looks like it ticked up a little bit. But basically, it's showing that inflation's still kind of proving sticky, but on a PCA basis, it looks like it got a little cooler. So anything else you want to say about PCE?
Yeah, throw out the whole chart. The only one that matters, the only one that matters to anybody is that year-over-year rate of change, which is continuing to decline. The year-over-year rate of change of PCE is extremely correlated. It's got like a 95% correlation to GDP because 70% of the economy comes from PCE. So, what that's telling you is that personal incomes declined. We're seeing slower consumer spending across the board. GDP is slowing. The economy is slowing down, and that's going to lead to less inflation later this year. But the only one that matters is PCE year over year. All the other stuff is just headline stuff that has no correlation to anything. But pay attention to year over year. That's all. That's the only one that matters. It matters to GDP growth. It matters to inflation because they all run together.
Okay, I just put the chart down, but I think year over year was flat.
But it's
or
still,
sorry,
but yeah,
it was up a bit, but the year-over-year number hadn't changed from month to month. So
exactly.
yeah. Okay.
But the overall trend, but my point is the overall trend is lower.
Yeah. Okay. And that gets to the next question I was going to ask you, which is let's give a quick update on the bond situation. And the reason for this is I have had, a number of interviews of late, including one that's going to come out tomorrow, the day after this video is released, with Jim Grant. So, James Grant, publisher of Grant's Interest Rate Observer, one of the most respected experts on interest rates. He believes, Lance, that interest rates are headed higher for much, much longer. He's talking secularly. So this is we have seen the bottom of the 40-year bull market in bonds, bull market in bonds, which is a 40-year decline in interest rates. He feels like going forward, we're highly likely looking at a multi-decadal secular rising environment for bonds. And he thinks in the next couple of years, interest rates will probably prove sticky and go even higher. Now, that being said, I did talk to him about, concerns about the lag effect and maybe dragging the country into recession in the relatively near term. And he said, hey, that's totally possible. Right. So yeah, we could fall into recession and the Fed could try to cut rates for a little bit, but then eventually they're going to have to go higher again. And I think they're going to be, secularly rising from here. That is not inconsistent with your outlook, but as I understand it, your trade has been, look, at some point we think that inflation is going to, in the next 6 to 24 months, it's going to come down. Rates are going to have to come down just to match that, because interest rates are a function of inflation expectations, or the lag effect is going to make a recession arrive, and the Fed's going to ride to the rescue and push rates down, and that's when our bond trade will pay off, and we'll get out of it. Did I summarize your trade correctly?
Well, let's start with Jim Grant's view. So first of all, explain to me how interest rates are going to go secularly higher from his view.
From his point of view,
what's the driver for higher rates?
I think he thinks that inflation will be more secularly problematic, and that's everything from reshoring and onshoring capital to just the fact that we're not going to be able to get away with as much fiscal intervention, the fiscal spending. Eventually we're going to have to pay a price for that and higher inflation. Well, let's start with those two things.
Well, okay, so let's talk about debt issuance. Then, of course, this is what we've been doing lately with debt. Obviously, and this has been, as I said earlier, the big concern of the bears is that all this debt's going to basically do what, right? Crash the economy, slow economic growth. And so, how are interest rates going to go higher if you have slower economic growth, considering that those two are correlated with each other? Well, here, let's just the bottom line is this: is that you cannot have higher interest rates unless you have higher economic growth. Okay, that's it. That's the bottom line. Interest rates are what? They're a function of supply and demand in the economy. Interest rates just don't magically do whatever they want to do on their own. It's a function of supply and demand. There is a lender that says, yes, Adam, I will loan you money, but I'm going to loan you money for 10 years. So I've got to make sure that coupon payment that we're agreeing to at 4% or 5% or whatever is going to compensate me for other opportunities that I may have in the future. And if the economy is growing strongly, I'm going to make more money by investing somewhere else than loaning you money at 4% if the economy is growing at 5 or 6. So my interest rate is going to be higher. So you have to make the argument for why interest rates for why economic growth is going to be higher in the future. And so this chart right here is a function of the deficit economic composite, which is basically wages, GDP, and inflation and interest rates. And there's a very, very high correlation between wages, GDP, and inflation. So unless you're going into an environment with higher, so let's assume for a moment he's right. Interest rates are going to go up from here. Okay. So what drives the big bulk of the economy right now, Adam? Debt, right? I mean,
I was
consumers.
going to say government spending, but yeah.
Well, but that's debt. But what about the
Yeah.
consumer? Consumers tapped out, right? They're running out of savings. They're piling on debt as fast as they can. So if interest rates go up, what happens to their borrowing cost? Goes up, right?
Yeah. Right.
Right. So I can't afford to pay the bills. So what happens to economic growth if interest rates go up? Same thing with inflation. If inflation goes up dramatically, the cost of everything else goes up, which means I can't buy as much. The economy's driven 70% by PCE, which is personal consumption expenditures. If that slows down, the economy slows down, which means that as a producer, which we just heard from Walmart, we just heard from Target, we just heard from a vast number of other retailers, they're now having to cut prices on goods that they're providing because they've got a supply of goods they've got to get rid of. So now they're having to cut prices. That's not inflationary. So if inflation is falling and economic growth is slowing, then interest rates as a function are going to track that. You can't have interest rates just living in an environment all amongst themselves. It's the same thing that Lacey Hunt says.
Yeah, and
Debt.
remember, you're talking to Mr. Team Lag Effect. So in the near term, I'm right there with
Oh
you,
no,
but
no, I'm not talking about near term. I'm talking about long
I
term.
I know, I see your long-term chart here. Yeah,
Yeah.
basically saying that you expect sort of secularly lower economic growth going forward, which I would agree with as well, given the trajectory of the debt.
Right. And in the end, now the game changer for that is AI. And as I laid out today, over the next couple of decades, if we begin this massive infrastructure build out, and this is all just speculation and hypothesis, right? I'm not making a claim that this is going to be the solution, right? There's just a hypothetical. But if we do have all this AI build out, we've got to build out the infrastructure. We're going to employ thousands and thousands and thousands of people doing construction, maintenance, upkeep, laying pipe, stringing wire, all kinds of, the demand for trade services is going to come roaring back because there's just simply not enough people to build out the electric grid. That's going to create the productive cycle that we're looking for, where those jobs are going to demand more money. They're going to have more money to spend. They're going to spend that in the economy, which is going to increase economic growth. As a function of growth, you're now going to get higher inflation because you've got more demand in the economy, but that's okay. There's nothing wrong with that because people are making more money, which as they make more money and spend more money, you have economic growth, you have inflation, interest rates come up because of the demand. And as that occurs, that causes companies to pay more in wages, which requires more spending in the economy. And we get this nice virtuous cycle. And this is why in the 60s, the 70s, 50s, 60s, and 70s, when we were a manufacturing based country, economic growth was rising. So was inflation. So were interest rates. For 30 years, we had rising interest rates, inflation, economic growth. We had one of the greatest periods of economic prosperity in U.S. history. It wasn't because interest rates and inflation was high. It's because we were producing stuff that led to a consumptive cycle within the economy. You do not have that today. AI is outside of the build out of infrastructure. AI is going to reduce the economic prosperity for millions of Americans because it's going to displace them out of work. So you're going to have a deflationary pressure from AI through higher productivity. The groundswell will come potentially from people building out the power grid, but that's a limited time frame until that's all built out. So at the end of the day, you're going to get economic growth of 2 to 3%, which means inflation interest rates will be about 2 to 3%.
Okay, which I mean,
And that's
I know
assuming the most optimistic of outcomes.
right, and I know you're making a secular forecast there. So just for the folks that are going to email us if we don't talk about it, in the nearer term, I'm presuming you think that there's, well, looking at the math, as you said, I think you expect PCE to continue to come down, eventually inflation to come down, therefore interest rates to come down, and your long bond trade will obviously benefit from those things. And if we end up getting some of the lag effects, which Jim Grant thinks are going to happen too in the relatively near term, that perhaps slow the economy faster than folks expect, maybe even towards recession, that might force eventually the Fed to step in and start cutting as it's been threatening to, and that's going to help the long bond trade too, correct?
Absolutely. And then when that trade plays itself out, we'll probably be out of bonds entirely and long equities.
Okay. But it sounds like, from a secular basis, you're kind of I don't know, I guess bond sort of positive.
Well, no, no. Look, bonds are an asset, right? So that's it. Bond prices move up and down. And again, it's interesting. You get one bad economic report today, interest rates move up. You get a good economic report tomorrow, interest rates move down. So people are just all over the board with an asset and trading it. So and that's fine. Just bonds are bonds. So if you've got a 3 month outlook for bonds, you trade bonds for what it is. I've got a 3 year outlook for bonds, and so I've got a small position in our portfolio based on that outlook. Um, but at some point, if rates get back down to 1.5 to 2.5%, not going to be much reason to own bonds because there's no more capital appreciation for the
Right.
bond,
There's not much downside yet.
right? And then when
Room for
rates
interest rates to go down. Yeah.
Right. And then eventually we'll go through another cycle where interest rates will move up for one reason or another. And then I'll buy bonds again. And, when there's plenty of downside in yields as the economy goes through its maturations, then there'll be, there's an opportunity to make money. So again, it's just, but when it comes to economics, there's a very basic relationship between inflation, interest rates, and economic growth. And those can't exist in isolation because if interest rates go up, you're going to slow economic growth, and especially in an economy that's heavily debt burdened, right?
Yeah.
This isn't the 70s. And, people will keep going back to the 60s and 70s, like, oh, we're going to have the 60s and 70s again. Not unless we have a massive shift from we were 80% manufacturing, which has a 5-to-1 multiplier effect in the economy during the 60s and 70s. We are 80% services today, which has less than one of a multiplier effect on the economy. It's almost deflationary more than it's inflationary versus 20% manufacturing. And that's why the manufacturing indexes don't matter. We keep seeing these manufacturing indexes, showing us negative recessionary readings and the economy keeps doing fine. It's 20% of the economy. 80% is services. It's Uber, Grubhub, and all the other stuff you're doing every day on services that's driving the economy right now. And until you run out of money and quit doing that stuff, the economy is going to keep going.
Okay. Well, look, in wrapping up here, I do want to give a nod to the topic when we turned off the camera last week. We kind of going back and forth and said, hey, we should do a video at some point in time about the topic of finances and relationships, right? My wife's a therapist, and it's sex, money, and kids. Those are the three big things that send people to couples therapy, right? And we're not going to get into a deep dive of it today, but I do want to bring up two quick things about it, and basically just test the audience's level of interest. If they'd like to see us maybe dedicate one of these weekly market recaps more fully to this topic, maybe we do it live and take some questions at some point in time. But in a relationship, there's this concept of the emotional bank account, which you probably heard, Lance. But this what I'm going to talk about comes from the school of John Gottman, who, if you ever read Malcolm Gladwell's book Blink, he actually starts the book talking about John Gottman and says that in like less than 2 minutes, Gottman can observe a couple and predict with like 95% accuracy whether they're going to be together, 2 years from then. And part of that's because he sort of put in his 10,000 hours, right? This is that whole book goes into the fact that if you've done 10,000 hours worth of something, you become a master, and you almost have the superhuman ability to see patterns immediately just because you've done this so often, right? And Gottman's very famous for having created this lab called the Love Lab at I think it's the University of Washington, where he ran this for many decades, observing real couples. But he talks about this thing about the emotional bank account, which is basically in your interactions with your partner, you're constantly interacting with each other, and they're either positive or negative interactions. And so it's like, adding a coin to the emotional bank account or withdrawing one, depending on whether you're having a positive or negative interaction with them. And he said that the masters of relationships, the folks that have really healthy relationships, they have a 20-to-1 ratio where you're doing 20 good things. You're depositing 20 good coins into the account for every one that you withdraw. He said people with those type of relationships just have the strongest, those are the strongest couples. He said to be sustainable, you need to have at least a 5-to-1 ratio. And he said that most people that come in seeking couples counseling and whatnot, they're down at the like 1.25-to-1 ratio, right? You're kind of smirking as I'm saying this, but I'm sure all of us, probably can.
These are hard. You're talking about lessons I learned the hard way.
Yeah, exactly. So, it's kind of interesting to sort of deconstruct, a romantic or emotional relationship to something this transactive, but it can be really helpful, right? So, it's one of those things where at the start of the day, if you're conscious about it, you say, okay, wait a minute, how can I make sure I'm starting the day by making some deposits, right? And at the end of the day, reflect and say, how many deposits did I make today? Was my ratio like 20-to-1? Or, was it even 5-to-1? Am I at least doing the bare minimum, right? But anyways, really important thing for folks to realize that if you find yourself under 5-to-1, or maybe if you're finding friction in your relationship, maybe one of the very first things to ask yourself is, yeah, what is my ratio? If I find out that I'm actually below the 5-to-1, then part of that's on me, and I got to figure out how to make more of those deposits. I've got one more topic on this to talk about, Lance, but I'm just curious, any general reaction to that besides the like, yeah, I've been there.
Yeah, no, it is, and it's like it was an interesting. I talk about stuff on a radio show on a regular basis, and Brent makes outtakes of it to run during our broadcast. But one thing I was talking about, my wife was traveling to Amsterdam just recently, and so the day she's coming back home, I go to the grocery store, stock the fridge with all of her favorite groceries. I wash the clothes, I wash the dishes, put everything away, straighten up the house, make the bed. So thought I did a great job, right?
Yeah.
And so she comes home, and I had flowers waiting for her when she got home. And I said, honey, here's all, welcome home. It's great. She she's awesome. Then next thing I know, she's got her shorts on, her shirt, she's got cleaning supplies, she's got the Roomba going.
Totally my wife too.
Yeah. And so I said, honey, I did everything before you got home. And she goes, no, you don't understand. This is my happy spot. Me doing what I'm doing right now is I'm just happy to be home. I really appreciate everything you did for me. That's awesome. I appreciate that, but this is just happiness for me to be cleaning and to run the Roomba and listening to music. I'm was gone for a week and a half. I'm happy to be home. And so it really, it just, what's important is you have to really understand. What took me a long time to understand is the emotional dynamic of women. Women are very emotional. And so every day I send my wife, a love message. Every day, first thing out of the day, I send, generally I'm up at 3:30, 4 o'clock in the morning. She's still asleep. I send her a love message and I get dressed and go to work. But every day, I'm always acknowledging her for being terrific, being a great partner, being a great spouse, whatever it is. And I don't expect anything in return. And that's the secret that you have to really come to, is that she shows her appreciation for me by doing, I want to be really careful how I say this. I don't want to offend anybody, but her wifely duties in terms of she makes sure that, I've got everything I need to do my job. She makes sure that, dinner's cooked at night when I get home from work, whatever it is. But that's her way of showing appreciation back. And so we've just developed this unspoken language in our relationship of kind of that emotional piggy bank that we both contribute to it on a regular basis. And it's amazing. Once we got to that point, when we were young in our relationship, we had, the frictions everybody had trying to figure it out, right? The way she operated, the way she thought, the way I operated, the way I thought, the way I control things, the way she controls things. We're both very independent people. And so it took us about 3-4 years of, struggling through learning how each of us communicate through our quote unquote love language. It took us about 3-4 years to figure that out. But once we did, it's been fantastic ever since.
Yeah. And I'm glad. I was going to bring up that concept of love languages.
Yeah.
So there are basically 5 common ones: acts of service, quality time, words of affirmation, physical touch, or receiving gifts. And a big part of success with your partner is understanding what is their love language so I can communicate to them in it so that they can see that I'm actually trying to express my gratitude for them. And so, well, look, it sounds like you're, well on your way to being one of those masters of relationships, Lance, with the 20-to-1 ratio, with those love messages. What Gottman calls these things are bids for affection, which we all do during the day. We make these different bids for affection. And what's really important is to be able to recognize them and then be able to determine how you want to respond. Because one of the things that can be really toxic to a relationship is unaddressed or ignored bids for affection. So like, let's say if you had done all that stuff for your wife when she was away on the trip and she came home and she didn't acknowledge it in any way, you'd feel pretty hurt and pissed off. Like, right, I made all these bids to show you that I care about you, and you right. And so learning to what they call turn towards the bids for affection, and say, hey, acknowledge them. Hey, that's wonderful. Reciprocate if you can, or even if you can't, just say, hey, look, I'm busy or unengaged, but I just want to let you know I am noticing those bids for affection and I appreciate them. First, you got to make them, right? If you're not making bids for affection, that's a problem itself in a relationship. But also, you have to be at least reflecting back to each other your acknowledgement and appreciation for them. It's a huge part of it. And again, if you can do that in the love language of your partner, it's going to be even more successful. The last thing I want to mention before we get off this, because there's so much to dig into this topic if folks want to. Gottman talks about, this is really interesting, says that 80% of the problems that you have in a relationship or the friction that you have in a relationship, it's perpetual. Like, you're not gonna fix it or resolve it, right? So like if you're an extrovert and your spouse is an introvert and you wish they were more extroverted, they're not going to change, right? Yeah.
Not gonna
Yeah. And so he says, in many ways, marriage or long-term commitment is a process of finding somebody whose perpetual problems that you can live with,
Yeah.
right? And if you're not in a long-term relationship right now, that's some of the most valuable advice I can give you when thinking about how much, whether to make a long-term commitment to somebody. But if you're already in it, like most of us, like Lance and I, your question then becomes, okay, well, how do I do a better job of managing these perpetual problems if we're having some issues? And what you want to be very careful of is, if things are not heading in a good direction, that you at all costs try to avoid what Gottman calls the four horsemen. And those are criticism, contempt, defensiveness, and stonewalling. And criticism's pretty obvious, right? It's just when you're always harping on your party. You always do this, right? Defensiveness is when, you're not willing to receive feedback. I don't do that, right? That's not my problem. That's your problem, right? Stonewalling, pretty self-evident. That's just when you just kind of shut down, right? And the person's just talking at you and you're just like not engaging, right? And that's not a long-term success strategy. But the fourth one, contempt, he says, is actually the worst one. It's when you have actively shifted from being on the team to your partner to being on the team against your partner, right? Where you don't like them, you just, you wish them ill. Right? Like when you see that start to bleed into the relationship, that's when the Gottmans are like, yeah, those are the ones that we feel like are not going to be around for very long. And obviously, if you're having issues with, if you see any reflections of those in your current relationship, that's probably a pretty good sign to work with a couples counselor or a couples therapist, because those ones can be really hard to self-repair on your own. But anyways, we talk about, again, the things that really matter in life. Money's important, but at the end of the day, money is a means to an end. It's not an end in itself. We talk a lot about, what really matters in life, and it really does seem to boil down to these three things of meaningful relationships, purpose, and health. And we talk a lot about health, and we talked, last time we went real long about purpose. The relationship part is really, really important. And everything I just mentioned, from the emotional bank account to the bids for affection to the perpetual problems in a relationship and the things to avoid, Not only do those apply to your romantic relationships, but they apply to your relationships with your children, with your friends, with your, your peers at work, with your bosses. So this is all really important information. So anyways, folks, if you'd like to see Lance and I, go deep into this, and again, maybe bring in some experts around this topic, maybe even make it interactive a bit, let us know in the comments section below. Lance, anything else you want to say about this?
Yeah, no, one of the, yeah, I mean, when you were talking about the four horsemen, my faults are being standoffish. And, that's, because when she gets mad at me, my first reaction is to back off,
Right.
right? And just to kind of shut down.
Right. Or bring up those defensive walls, right?
Yeah, exactly. And so, getting defensive is kind of our first inclination is to do that. So we basically both learned a saying, which is when we get into that position, I'll like, since if she's really mad at me or she's done something that's made me mad for whatever reason, which rarely happens, but if it occurs, I'll say, I love you always, but I don't like you right now. Because just because I love her, which I do, doesn't mean I always have to like her. And so, but when we say that, it's like, okay, I've upset the other person. If she says it to me, okay, I've upset, okay, that helps you be less defensive, okay? Because now it's like, well, why don't you like me? Right? What have I done that you don't like that made you not like me? And it kind of brings down that defensive posture to where you can actually start having a dialogue. And like for my wife, she gets very wound up in something. So when something happens and something winds her up, generally it has nothing to do with me whatsoever. It could be something at work. It could be something that happened outside of the house somewhere that I'm not aware of, but she can get very wound up and she'll take it out on me because, I'm her spouse, I'm easy, I'm right there. And so she'll, start to take things out of me. And I'll say, you know what? I'm going to go to my office now and I'll be back in half an hour. And so I just leave and I don't comment back. I just leave. I go to my office. I spend about 30 minutes doing whatever. I go back in. She's calmed down. Now we can have a conversation. But sometimes it's just, she gets so wound up emotionally, she doesn't know how to express what it is. And generally it has nothing to do with me. It's just, she needed to get it out and she just couldn't get it out, in a verbal manner.
So my wife would be applauding you guys because you talked about two things that she mentions all the time. One is when in a conflict with your partner, you really want to use I statements, right? I feel this way. This is how what happened made me feel, right? Rather than you did this, you're bad, right? You're not projecting intent or blame on the other person. You're just saying, look, my reality is this is how I'm feeling, right? And the person feels a lot less attacked and generally will say, oh, well, I don't want you to feel that way. So what can I do to make you not feel that way, right? So keeping it on the I side is really important. And then you talked about your wife, well, what the therapist will say is getting flooded. And basically we have this window of tolerance emotionally. And if we drop below it, we check out. If we rise above it, we get emotionally flooded, and we're not productive in either of those two extremes, right? So what you need to do is when you realize you're outside your window of tolerance, you have to take a cooling off period, right? Or do what the therapists call self-soothe, right? But get yourself back to where you're a little bit less emotionally charged or emotionally checked out. And then you're back in the place where you can actually have a constructive discussion. So the fact that you guys are actually already practicing that, like, hey, I realize that we're not in the right headspace right now to have this conversation constructively. Let's go to our corners, cool off a little bit, then we'll come back, right? Very key part of working on, again, what the therapists call repair.
Trust me, I learned that the hard way, right?
I'm sure you did, but at least you learned it.
When you first started out, it was, put on the gloves, man, we're going now. And it took a while to figure out it's better off just to walk away. And then, she'll calm down. Generally, she comes in and she's like, I'm sorry. And, then we can have a conversation. So,
well, what's so one of the reasons why I'm really, raising this as an important issue that maybe we want to talk more about is, again, my wife's a couples therapist and we were in Northern California and she had a lot of clients who had a lot of money. I mean, we're talking Silicon Valley crazy money, right? Hundreds of millions, if not more. She's had some billionaires as clients. And it's amazing how above a certain level, money does not guarantee happiness, right?
Yep.
In many cases, these, a lot of these people are deeply unhappy, and money has no ability to improve that. Or in a lot of cases, money is a contributing source to this. Either it's anxiety they have because people want them for their money versus who they are as people, or it's we're really wealthy, but my spouse made it, and if they ever leave me and I don't have the money, who am I without that money? Maybe it's I had a lot of money and it ruined my kids, right? There's all sorts of issues around money that suggest that it is not a panacea. And even though it's a brass ring that most of us chase so much and aspire to have more of, I think we have to be really cognizant that, like I said, it's a means to an end. And in a lot of ways, there's a lot of costs that can come along with it. So, focusing on the things that really matter, quality of our relationships and whatnot. I mean, that's where the real value lies in life. So, anyways, folks, if you're hearing anything in this discussion that makes you think, hey, let's dive more deeply into this, let us know in the comment section below. And if there's enough interest, we'll definitely do this. All right. Well, look, in wrapping it up, Lance, it's always great to hang out with you and spend time, my friend. Folks, if you
Don't forget trades.
if oh yeah, that's right. Okay, let's get to trades, and then I'll make my little joke.
It's really short. We sold Costco. What is today? Friday. So yeah, we sold Costco Wednesday. We reduced it just a little bit. Costco's had a huge run to all-time highs. So we just reduced it just a little bit going to earnings. Stock's down about 3% on Friday after earnings, but we love that company long term. That's one of those positions that we've owned since we started the portfolio. We'll probably never sell it. We just buy it, we just trim it and then buy it back on a dip. So we'll probably buy Costco back at some point, but we just took a little profit in it.
Okay, and this is again just your gardening, your position sizing, which is some of the best practices of portfolio management that you keep mentioning, month in and month out on this program.
Yeah, it's not hard.
Yeah, but you're just practicing what you preach. Okay, great. And that's the only trade that you made this week?
Yeah, it's a
Okay.
pretty small week outside of that.
All right. Well, folks, look, if your love language is listening to Lance during these weekly market recaps, please let him know by well, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. A huge thanks to those of you who have been hitting that subscribe button, because as mentioned last week, we are now less than 10,000 subscribers away from the big 100,000 subscriber milestone, where we get the fancy plaque from YouTube, and hitting that milestone also tells the YouTube algorithms to give this channel more love. And so it really will help us if you're watching this and you haven't yet subscribed yet, if you do take the time to hit that subscribe button. Just a reminder, if we already talked a lot about the challenges of being a DIY investor, and there's absolutely nothing wrong with it. And I cannot wait, Lance, for the DIY investors who watch this show to get the full Monty on the new SimpleVisor solution when that's ready to go.
Yep.
But if you're one of the people that really would like to benefit from the guidance of a good financial quarterback who can do all the things that we talked about earlier, taking into account all the macro issues that we talk about on this channel, then fill out the short form at thoughtfulmoney.com to get a free consultation with one of the financial advisors endorsed by Thoughtful Money, perhaps even Lance and his team there at RIA. Also, too, while you're there at thoughtfulmoney.com, that's where you can sign up for our free newsletter. And you just do that by hitting the newsletter link at the top of the website there. All right, Lance, again, it's always a great pleasure to do this with you week in and week out. Thanks so much. Any last words for folks here?
Nope, that's it. We'll see what kind of happens, next week. We've got, we're kind of right in the middle of just kind of no man's land between no earnings and the beginning of earnings season starting in July. So we're just going to kind of be really focusing on economic data, and I wouldn't expect a whole lot out of the markets between now and then.
All right, buddy. Well, thanks so much. And whatever happens, we'll see you here next week. Everybody else, thanks so much for watching.